Hello, welcome to the Economic View once again. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Look, today we've got to talk about the inflation figures that are out. To me, it showed that the REIT was up, slightly on the last quarter, but gains in certain areas, in particular fuel, electricity. But I thought I'd let you talk about the figures in detail, Evan.
Yeah, so as expected, the headline figure was, as you said, up quarter on quarter. It actually, for the seventh consecutive month or quarter in a row, analysts have been overestimating. So it actually came in under what the analysts expected. So headline figure came in at 2.1%. Expectations have been 2.2. I'll have this chart on screen coming out at the moment, which I think is the best way to explain it to you. You can see those numbers there, headline figures, quarter on quarter came in at 0.4 versus 0.5. If you unround it, actually, it's at 37 basis points, and that's the lowest it's been on a growth figure in 6 quarters. So it's not what you'd call brilliant. And then if you look at the core trim mean figure, it was bang in line. So it came in at 1.9% year on year. It came in at 0.5 quarter on quarter. All well and good. The interesting thing about it, and the reason I deliberately wrote down everything I needed this time, is because the subsectors you alluded to are quite diverse. So for fuel, as you alluded to, petrol prices, if you probably well knew, and you probably felt it at the Bowser particularly, between April and June, really ramped up. So world oil prices went up. We know that. If you look at the Australian sort of derivative of it, it's Tapis crude is where we get our petrol refined from. So that was $7 US over the US WTI, and the Aussie dollar fell during that period. So not surprising. So having a look at transport, which is where it encapsulates that energy space, 1.6% quarter on quarter, and it was a big number, 5.2% year on year. So really strong. Standout also, you can't go past at the moment, is health. 1.9% year quarter on quarter, 3.4% year on year. It is an incredible, almost stalwart in that space, and just continues to add numbers. The other one that was really interesting that really added numbers and really added points to the headline figure was alcohol and tobacco. Jumped 7.8% year on year. Now that's quite interesting. There wasn't any major new taxes. There wasn't any major new changes. It's just a big increase, and it's been put down quite significantly to, again, the Aussie dollar and the imported alcohol's price, and then tobacco as well was a very big increase on that. Before we get back to a couple of other things, negative side, you can't go past it. What's very interesting also is that what we call demand-led sides, things like consumption, they are really, really poor. And so if you look at things like clothing and footwear, so apparel, it fell 2% year on year. That's a really, really significant slide. Communications, so we know what's going on in the communication space. That fell 4.2% year on year. So there are some really interesting things. The big one, and let's now talk about that, which we can sort of bring in, housing. So
we've got to talk about housing, but as you were saying, quite a mixed bag there, and a few, as you say, alcohol and tobacco, a little bit unexplained as to why that's going on.
As I said, that's an interesting one. I think you can put that down to a bit of an outlier. I don't suspect that will be held at that kind of level. None of that. The consumption of alcohol and tobacco and the overall scheme of things isn't as high as it once upon it was. Food and that sort of side, food and beverages were strong, and again volatile, added points. But again, the deflator is food inside of that, whereas the inflator is alcohol, and therefore, if you flick that around, you probably actually see that food is still probably the slight contractor, and therefore taking points out as a collective group rather than just alcohol and tobacco.
Yeah. So let's talk about housing and then move on to what this means in terms of the Reserve Bank and its target band, whether this creep up is anything to be concerned about at this stage, or whether it's really just going to sort of keep the RBA sort of on watch mode.
So looking at the interbank market on the drop, so that's actually the market that basically prices in through the 30-day swaps market. We don't have to worry too much about it, but watching it in terms of the expectations, again, fell right away because they're not seeing demand-led inflation recovery in the core figures. And therefore, getting back to your question around housing, twofold. The inflation in it is slowing, so it's still growing quite a clip, 3.1% year on year, but that is down from 3.6% last quarter. The estimate had been, and if you look on quarter, it grew at 0.2 of 1%. Estimate had been for 0.5, previous quarter 0.7. So housing is clearly slowing down. And that therefore also takes the pressure off the RBA, because we know that they'd been worried about a frothy market, using their words rather than sort of the B word and staying away from that term. So housing is slowing naturally, and therefore that is taking pressure off the RBA to act on a regulatory basis. Rate side, and rates are clearly showing, and getting back to the interbank market, the expectations shift right out. So 2020 is where the majority of people see the market seeing the possibility of an RBA rate rise, but it needs to see trim mean inflation being probably 2.5%. We are, 70 basis points away from that. 70 basis points away from that. That requires some serious work, real serious work from the demand-led side to pick that up. Now that means wages have to increase, and therefore our ability to therefore consume increase. So can you see that happening inside the next 12 months rapidly? I can't.
No.
And for that reason, the RBA is out of the market.
Yeah, I agree with that. I mean, the other signs aren't really there. You know, employment's still strong, wages still fairly stagnant.
Yeah, so we have to wait till August 15 now. Realistically, that becomes incredibly important to this whole debate, because that is when the next wage price index is released. So the 15th of August will really play out even bigger, because it's just such a subsector inside it. We know the RBA is putting a huge amount of emphasis on employment going forward, that it's almost becoming as, if not more important than the release today.
All right, Evan, we'll leave it there for today.
Thanks, Tony.
Thanks for joining us on The Economic View.